Welcome to Developer Diaries with Ben Wilson in association with the All About Property Facebook group.
Hello and welcome to the 5th episode of Developer Diaries. It's flown past. We've managed to get to episode number 5. Only seems yesterday we were doing the first one. I'm joined by a very interesting guest today, who I will come on to more about later. But as with all of our podcasts, or all of my podcasts that I've done so far, the first part is to do the market update and discuss a little bit about how the property market is at the moment. We've certainly noticed and when I say we, I mean my business noticed a little slowdown in the market. Prices have softened slightly. Certainly with the first-time buyer market, it's not as strong as it was 6 months ago. And recently we sold a property which we sold for very slightly less than we projected on our GDV, only £5,000 less, which really was a minimal difference, but still significant, as we normally will always sell in excess of our GDVs, certainly for the last few years. And I think that's probably in line with things slowing down and people having to pay more money on their finance and therefore not spending quite as much as perhaps they would have done 6 months ago. We've also had the return of 100% mortgages, which has been a huge thing in the press, which my guest Rick and I might talk about a bit later. But I think that's really been a little bit over dramatized. There's a lot of restrictions on who can take that product. You have to have paid your rental for 12 months previously. And for example, if you're renting at £1,000 a month for the previous 12 months, you couldn't take a mortgage where you're paying any more than £1,000 on that mortgage. So it's very restrictive. And in reality, a tiny percentage of the market is going to take advantage of that. And it's quite expensive as a product. So I think all of the hype about 100% mortgages coming back and it being terrible is massively overplayed. And I don't think it will really play out too much over the next coming months. The other one thing that has also affected the market a little bit is obviously interest rates have risen again to 4.5%. Historically, I mean, high in the last, since 2008. But if you look back 30 years, 20 years, 4.5% is probably where interest rates should be, roughly. I think we've just come from such a low starting point that people obviously see it as very high interest rates. But I certainly remember the times when I was paying 4.5%, 5%, 6% on my interest rates back in 2005, 6, 7 before the the Great Recession of 2008. So it'd be nice if they came down. I think we'll talk about 1 year and 5 year swap rates later and where we think they're going to be heading. But certainly this year they still seem to be going up a little bit to try and get inflation under control. And just from the market itself, I'm finding that buyers tend to be quite a lot more flaky than they would normally be. So when we had our Sutherland Avenue property on the market, the last development I did, we actually had 3 offers. 2 of them withdrew within 2 days of making the offer. And then the third one eventually exchanged at the price that was probably £25,000 to £50,000 less than we would have got 6 months ago. So the market does seem to be punctuated with buyers that are a little bit trickier to deal with and aren't quite sure of what they want and whether they're actually going to proceed forwards and buy something. So that's how I see things, and let's see how the next few months pan out. So now the main part of the podcast, I am joined by Rick Hollingsworth.
Hello.
From Octane Capital. I should give you a bit of background. I've been using Octane Capital for about 4 years now.
Yep, that sounds about right.
Something like that. Yep. And Rick's been my port of call, had me calling up, whinging at him, making his life difficult. No, I haven't really, have I? I think we get on pretty well.
No, you're a great repeat client of Octane, and we're very happy to look after you. But yeah, I mean, I've actually been at Octane for about 5 years myself, so you've kind of been a forever present of my career at time at Octane.
Oh, that's good. I'm not sure that's good for you or bad.
No, it's good. No, it's good. And what's great about dealing with people when they're first starting out in property development and being able to be there at the genesis or towards the genesis of their journey and actually watch them grow, is actually very rewarding. Finance can be often quite a dry thing to do day in, day out, but one of the real pleasures is actually being able to help people, actually achieve their business goals, really. That's what we're there for. You wouldn't come back and borrow from us again if we weren't facilitating your journey towards...
No, I mean, when I first came to you, I've been a professional developer now, I think, for 8.5 years. I've probably been a professional, as in full-time, deriving my main income from developing for about 4 years at the time. So I was just starting to do bigger deals. I think the first deal we did was Queensgate Place.
Yep, that sounds right. Yeah.
Which we bought for 1.3 million. We bought for 1.35. We sold for 2.3. It was a great deal. And you finance that with a development loan, which we'll go into the ins and outs of development loans versus bridging loans and all the other ways to finance things. So today I just thought it was a good opportunity to talk about all of the possible ways, if you're getting into the development, you're able to finance deals, the pluses, the negatives, the risks, the rewards. And I thought Rick was the ideal guy because he knows a lot about development finance.
Yeah, I mean, look, I'll certainly try my best. It's obviously finance in general, and obviously we're going to focus here largely on property finance. It is a vast subject, and it is quite dry, and so much of it can really depend on the specific circumstances. So I will try and talk broadly, and I'll talk about my experiences, and particularly through the lens of Octane, where I work. But obviously, if you've got any questions then that are more broad than that, or you want me to expand, I'll certainly do my best to do so. Yeah.
Well, yeah, as I've mentioned to you, Rick, the podcast is aimed at people that are aspiring to get into property development. There's a lot of sort of what I see is I'm quite against all these property courses. I think some of them are great, but there's a lot of people out there taking money off people for giving them bad advice. And the reason I set this podcast up was to try and give back a little bit and actually give some of my knowledge from the last 19 years working in property. And so it's an educational podcast. So
great.
We'll try and give people as much information as we can. So if we get straight into it, I think the first thing that we probably need to talk about is the various ways to finance property. Now, obviously the ideal, on the face of it, the ideal way to finance property is cash. To have a nice big pot of cash. There's 10 million quid or £1 million. Go and buy what you want with it. It's really easy. You haven't got to deal with a lender or a mortgage lender or whatever.
This sounds like the dream, right? To be able to just have your own cash pot and be able to do with it what you wish.
Well, yeah. I mean, look, in the real world, obviously the benefits of buying as a cash buyer, speed of transaction, which is critical. In reality, if you're going to compete against developers, if you're going to be buying the market that we buy in, for example, saying you're going to take 6 to 8 weeks to exchange, you'll be very lucky to buy anything. You might get the odd bit of scrap that someone else doesn't want. In reality, all of the big boy players who are full-time developers, they're all going to be cash buyers. They will buy it, refinance it, whatever. So we'll talk more about that. So the speed of transaction is critical when trying to buy as a developer. And obviously you're then at the top of the pile. Although I would say that a lot of the areas we now operate in, so your Kensington, Chelsea, Westminster, places like Notting Hill, 70-80% of the market's cash.
Right, yeah, I can well believe it in those markets.
So actually, you think that you've got rid of all the end user market, and you think, yeah, great. But actually, when you're in Knightsbridge, probably 90%, I would think, in Knightsbridge, maybe even 100% in some cases in Knightsbridge, you very rarely get mortgages. People are just so wealthy, they don't need mortgages. So you don't always have that. You're not ahead of them as much as you think you might be.
Yes, it might just actually be your ticket to the game in those super prime markets.
But there is then a difference between, it's one thing having the cash, but it's also acting on that cash. And when I was an agent years ago, it used to really frustrate me. Buyers would have maybe cash buyers, and I'd be like, right, you're a cash buyer. Now you need to behave like one. So you need to basically say that you can attend exchange on this property in 3 or 4 hours. I'm going to get you a great lawyer. He's going to cost you 5 or 10 grand to do it. And we're going to have to indemnify against lack of searches, blah, 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 blah.
Yeah.
But if you want this deal and you want to compete against a developer who's going to do that, you've got to do that. And the buyers be like, oh, I don't think I can do that. I said, well, you can. You just don't want to do it. So a lot of people that are cash buyers, they don't behave like cash buyers. They behave like a mortgage buyer. And they go, well, we can do it in 3 weeks instead of 5.
I see what you mean, yeah.
So you need to, it's important that if you are cash, act like a cash buyer. There's nothing stopping people if they don't have any development finance or mortgage finance from exchanging on things very, very quickly, assuming the seller's solicitor is equally clued up.
So in that circumstance, you are, like, when you say act like a cash buyer, you are inherently going to accept some additional risk.
Oh, of course, yeah.
So, if you want to behave like that, you may even rule out some of the other finance options that may be available to you, which I'm sure we will come on to. Yeah. But if you are willing to accept more risk, then for sure you are going to put yourself in a position where you can transact quicker.
Well, I think we'll talk more about this in a minute. But for example, when I'm doing a deal with yourselves and we're buying as cash buyers and we're going to bring your finance on afterwards, I know what more or less what your minimum requirements are for you to greenlight and stamp a deal.
Yeah.
And I will regularly ring you and say, Rick, I've got this problem or this issue. Will you lend? We'll put down a bit of a bigger deposit, whatever. Okay, yeah, we can do that. That's fine.
Yep.
And you guys are normally very good, I have to say, in terms of the lenders I deal with. You're the most flexible, I think, and you do try and find solutions for problems, which I find a lot of lenders, especially the bigger banks, they're just like, computer says no, can't do it.
Yep.
So that is definitely a benefit of using Octane. But so I mean, the negative of cash, of which you may not think there are any negatives, but there are. I mean, one of them is there's less safeguards. If I've got Rick lending me money via Octane, they've got their own solicitors. You're checking everything we're doing, making sure you're happy. It's much more easy to be reckless when you're just charging him with a pile of cash and trying to buy something.
Yep. You can often get so enticed by the opportunity that you forget to think about the risks. And if lenders are good at one thing, it's probably concentrating on where risk sits.
100%. I would agree with that. I think the other thing that's a negative of buying with cash is that return on equity invested is a really important thing in property development, and essentially what that means is how well are you getting your money to work for you. So if you're buying something for cash at £1 million that you can make £200,000 profit on, that's great. But if you can put down 500 grand on 2 transactions and make 200 grand on each of them by leveraging, you're making double your return. As a very oversimplified example. Of course, you've got double the risk. So if the market drops and you lose 20% on both, you're 400 grand down instead of 200 grand down. But in reality, property development is all about the churn of the cash that you have, and how quickly you can churn deals out.
For sure. And the other constraint with cash is, firstly, you have to have the cash to be able to do it, which not everyone does, to be able to transact, to be able to buy a property outright. Then the second aspect, and it speaks to the opportunity of being able to do more, is you're also then constrained by the amount of cash you have. So if you bring on other financing avenues, you've got more opportunities to deploy that cash on a range of projects, for sure.
Well, I think going through my sort of career as a developer, from starting with very small projects to now getting a little bit bigger. I mean, I still think that we're very small, but we've certainly gone up the price brackets quite a bit. I started out using my own money to do small developments that were like 400 grand. And then after a while, improving having a track record, I then went into business with a high net worth individual. We both put in an equal amount of money to be able to buy 1 or 2 fairly large deals together. And then gone from that model now to investing with my own money, but also doing joint ventures. And I think joint ventures are a great way to expand a development business. They're normally sort of 50-50 split joint ventures. So normally the investor will put the money in and the developer will do all of the work, find the deals, design everything. Sometimes there'll be a coupon in the investor's favour as well. So what I mean by a coupon is that they're also getting a return on their money. It really, from our point of view, it depends on how much money the investor gives us. If they're giving us 7 figures, then we will consider a coupon. Otherwise, we generally do a straight 50-50 split. Right. So it may be that an investor gets say 3 or 4% coupon on their money that they put in, for example, as a just a ballpark. So that's generally how joint ventures are structured. I mean, other people may do it differently.
I have to say, how you've just explained joint ventures, I mean, I don't have perfect knowledge, as it's not something I've ever specifically been directly involved with, but the joint ventures we see as a lender that are undertaken follow that format for sure. So I don't think you're describing anything there that's outside of the ordinary as I see it.
I think the thing is, Rick, that especially as you go up and you do bigger deals, so you're doing £1 million, £2 million, £3 million, £5 million to even £10 million deals, the amount of work involved to get, and especially if there's a planning game that has to be achieved, dealing with neighbours, licence for alterations, getting planning, listed building consent, it's a real ball ache. Yeah. It's a hell of a lot of work. And I think that split is probably fair. You may get people that do it slightly differently.
No, I do genuinely think that is a fair reflection. Right. Like you say, there are always going to be specific circumstances.
I'm going to play this to all future investors I deal with. And
but no, I do genuinely think that's fair. I think the coupon to investor, I think you see that more often where there's a lot more risk involved in the deal. So for something like what you would undertake typically in central London, where you're talking about quite quite prime properties.
Yeah.
You're already an experienced developer. I think that coupon being available is probably less prevalent in those sorts of scenarios. I don't know. Like I say, I'm not an expert in that field.
There's something to be said for having really uncomplicated partnership agreements.
But I think if you were probably in a ground-up development, perhaps outside of London, you might expect that
stuck in it for a long time.
Exactly, you might expect that investor to perhaps like want something more than just the equity upside. You know, they might want that coupon.
That makes sense.
Yeah.
That makes sense. So we've talked about doing a 100% cash deal. We've talked about a joint venture, which is normally an investor putting the money in, the developer doing all the work. If you're not going to finance it, if you're not going to finance a joint venture with cash, which in the past I have, but also we don't tend to now for the obvious reasons of trying to get a better return on equity. Bridging and unregulated finance, because really what we're talking about here today is unregulated finance. So what
for sure.
Do you want to explain a little bit between what bridge and development finance the main?
Yeah, I mean, just for some historical context, I guess, and I'm by no means a finance historian, but really after the financial crisis, I think you have seen most of the main high street banks retrench from what I would classify as sort of small to medium size property loans. So some of the banks still do participate in it, but to a far lesser extent than what they did. And what that's really given rise to is a lot of alternative lenders, either be it startup banks or alternative lenders that are either privately funded or funded by other institutional money. Yeah, like for example, Octane's funded by institutional money. But and really where these institutions compete, where traditional banks might not, is really being able to transact quickly, transact with a level of individuals who've got expertise in the field, and I guess deliver a product which might not otherwise be there because the main banks don't seem that interested in it. But really, we provide two basic products, I guess, which is a bridging loan and then like a refurbishment or development finance loan. And a bridging loan, in its very, very simple terms, would be for a property acquisition or maybe even a refinance of a property or an auction purchase, just where you need to facilitate the acquisition of a property or the refinance of a property in a timely manner.
With minimal works.
With minimal works. Now, we might actually allow a bridging loan client, let's say if a typical transaction might be they're buying a residential house at auction. They want to maybe spend £50,000-60,000 doing a little bit of a tart-up on the property, and they might want to self-fund that work themselves. So we might be able to facilitate with potentially like up to 70% loan to value against that purchase. Right. They spend a bit of their own money just doing a bit of a tart-up, and then they might either retain that themselves in a buy-to-let portfolio refinance, or they might actually seek to sell because they think there's been an uplift in value. And that would be a fairly typical bridging loan transaction. On the sort of refurbishment and development loan side of things, it's quite a range really with what a refurbishment can look like, from something as simple as a tartan term where the borrower doesn't have their own money, I guess, to do that, or right the way through to something that's more structural, doing extensions, maybe putting a mansard roof on, completely reconfiguring a property.
Yeah, which tend to be what we
which is something more typical.
Well, we normally do a bridge and then we will convert it to a development loan.
Yeah, so that would be
if I can bend your hand to let us not have to do the development loan.
So that's another really good example of where a bridge might be appropriate. You're acquiring a property and you've got a plan, but you might need planning consent, you might need freeholders' consent if it's a leasehold, and there's a lot of ducks you need to get in a row before you move on to a refurbishment.
Sutherland Avenue that we did together, I think, was just that was a development loan. It was a development loan, Sutherland Avenue.
Yeah, it went straight into that.
It was actually. Yeah. I actually took private funding as a bridge initially on that, and then you knocked that out of the way with the development loan.
Yeah.
I remember. Yeah, good.
So the key difference really with a refurbishment loan is that you will have a day one value. So let's say you're buying a property for £500,000. You want to spend £100,000 on it, but having spent that money, you believe there is an enhancement in value. And really what a refurbishment loan enables you to do is to not only borrow the money towards the purchase, but also borrow the money to do the work. Yeah. And what we were able to do as a lender is almost lend you the money to do the work, because we are reliant on that future value. So we can allow our loan to go beyond a leverage which we would be able to do if it was just lending against the day one value. But because we know there's that increase, as long as we monitor you doing the works and we know you're doing the works, we can lend against that future value. And what we can also then do at that time is allow interest to roll onto your account, because we know you're travelling towards that future value.
So if you've bought something for, I mean, let's look at Sutherland. If you bought something for 800 grand, which is probably going to be, if you're doing your job right as a developer, it's going to be below market value anyway, by at least 10-15%, I would think. But anyway, if you know it's going to be worth 1.3, like ours was when we'd finished Sutherland Avenue, then you know that you're tracking towards that, and therefore there's headroom in the facility.
Yeah, exactly.
I often hear you talk about headroom. You always say that, well, there's headroom in the facility for you to borrow a bit more if you want. Yeah. So that's kind of a phrase I hear a lot. But so in terms of, we've talked about the difference in structure between a bridge and development finance. And in terms of, a lot of the people that listen to this podcast are either in the property business or aspiring developers, or maybe already developers trying to get, move up the developing ladder, so to speak. Can you lend to first-time developers?
Yes, I think you can. I think the question really is, what are they doing, and what's their other experience? I think if you were an 18-year-old and you look, and you've got no prior property experience and you want to take on an incredibly complex project,
Tricky.
That's going to be a really difficult underwrite for any lender. There might be someone out there who would do it, but I would suggest that would be quite a difficult sell. But if you've been quite successful in another walk of life, you've maybe run your own business and you've now started to make some money and you want to deploy it in
just somewhere.
And you've got some spare cash and you now want to employ it into property development. You've got a track record of being someone who's clearly very professional and capable of doing something in some walk of life. And I think as long as you surround yourself with the right people, so you're employing a good contractor, for example, if you've got no experience.
Contractor is very important.
Maybe you have got a joint venture partner who has got property experience, or you've surrounded yourself with a really good quantity surveyor, or someone who's just got some expertise in the industry. And you're not biting off more than you can chew. It's maybe a fairly straightforward project for your first scheme.
Refurb, not
then absolutely. But you can't run before you can walk. And can you get access to the very best leverage? Maybe not. Maybe you have to clip in
the rates might be a bit higher.
Exactly. So maybe everything we do at Octane would be a judgmental lending, is what I would say. So there's no scorecard, as it were. We are looking at every case on its merits.
I think the one thing I've learned from dealing with yourselves and some of the other, although you do many millions of pounds of lending compared to, say, one of the big banks, you're a smaller company, right? What I've learned from dealing with you guys and some of your other contemporaries compared to, say, UTB or something like that, but they're very faceless. You don't really have a contact like I speak to you.
Look, we would actively encourage either our clients, or a lot of our clients are introduced to us by brokers, who are another great resource for getting access to finance. We definitely encourage speaking with our underwriters so that you can really get a feel for who you are, and you also get a feel for where the pinch points are for us too.
In reality, you have a credit committee, right, who signs off on all your deals. So the directors of your company will sit together every week or whenever it is and go, right, this is it, this is the guy, this is how long he's been developing, this is his team, this is the site, this is the GDV, this is, the return on equity, blah, 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 whatever your metrics are for looking at it. So I think what Rick's trying to say is, if you are lacking in one particular area, say you are 21 and you haven't developed before, but you've been an estate agent for 3 years and you've sold loads of property, the property market inside out where you're working. You've got a great builder because your cousin's a builder and he's known for being a great builder, but you're lacking in a certain area. Maybe you haven't got business experience. If your business partner that you're going into it with is a 40-year-old that runs his own company and he's going to be executively involved day to day to help things.
Yeah, for sure.
Then you're much more likely to go, well, actually, this is lacking, is made up for by this, and we like we like the scheme, and we'll lend. Although we'll lend 5-10% less on day one as a result to cover ourselves a bit.
Exactly that. It's perfectly explained. Yeah. Everything will be on its merits, really. So for sure, I wouldn't dismiss it at all.
Because that's good to hear. Because a lot of the time, people say, "Well, we don't lend to first-time people in all sorts of things." I had it on some car insurance recently. I tried to insure one of my employees on my car, just as I wanted, as a bonus, basically, and at work. And they were like, "Oh, well, he's got no experience driving a car like this." And I thought, well, hang on, if you've got no experience driving the car and you went to
ever get it?
how does he ever get it? And it's the same with this. Like, if you won't lend to first-time developers, then how do they ever do it? That's why people do the naughty and take mortgage finance and do the mortgage fraud route, which I do not.
Yeah, I'm sure we'll
come on to that.
Yeah, I think often where the pinch point truly is there is that when it's your first project, you probably don't have the level of equity to be able to put in. As we sort of allude to, maybe one of the key ways in which a lender can mitigate its risk is reducing its leverage or its loan to value. And that's probably the bigger pinch point, actually, that maybe you do need to bring on that joint venture partner because you haven't actually just got the cash to really push yourself into the lending market for your first scheme. Yeah. And I know that's probably painful with the idea of sharing some of your profit and your upside, but if that is the way you cut your teeth or enable you to borrow but maybe at lower leverages, then I think you probably have to just look more broadly.
The joint venture way is a great way. I think the thing that annoys me a little bit, again, it sounds like I'm so anti-courses, but a lot of these courses talk about, just go and find someone who's rich, got loads of money, and they'll give you money with no experience to suddenly start buying up houses in London and you're going to make loads of money. I mean, it's just utter crap. I mean, I did it the other way around, and I built up equity in my own home, and then I sold that to invest into a development business. Yeah. And then I didn't do my first joint venture until two and a half years ago. I've probably done 5, 6 since then. And they've been great. But I do think the joint venture where you do have to try and have some track record. The way to get into it a bit more easily is to find either a family friend or a family member that has a bit of cash and do a 50-50 transaction. And when I was much younger, I did something like that with my father, where I said to him, look, he had some spare money from his pension, and I said, look, I found this deal. Let's do it together. Put 50%, put the money in, I'll finance it, I'll pay the mortgage, blah, 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 and then we'll split it 50-50. It was no different to a JV I would do now, albeit, of course, I had to have the trust because it was my father, right? Yeah. And I'm very open about that. Obviously, that helped.
Yeah, no, for
but
sure.
equally, he didn't just say, oh, you just keep the 100%, son.
I'm sure he didn't.
I want half.
Yeah.
So, he made a lot of money out. I made money out. It was brilliant.
Yeah, you for sure, you're going to have to share that equity upside.
You've got to think outside the box a little bit with these things.
And I think, I suppose the other slight risk, I guess, for the first-time entrant, if you really do push yourself on the leverage front, is that things do go wrong in property development, and actually being able to have, not fully committing all of your cash and deploying it and not keeping at least something in reserve to just roll with the punches a little bit. If you are really, really stretching yourself, then you are exposing yourself, I guess, to potentially a lot of risk.
I mean, I have to say it's very rare that development deals don't go over budget.
Yeah, I'm sure.
I don't think we've ever had one that hasn't. And saying that, we normally get more for our deals, as I've said before, than we expect. But it's the nature of it. There's big inflationary pressures on all construction materials at the moment. There's a lack of builders, and even the builders who 3 or 4 years ago would have been classed really as labourers, not as skilled trades. Yep. They instead of charging £100 a day like back then, they're now charging like 200 quid a day. Yeah. And they don't, their skill set's still the same really, but because there's such a shortage, the best chippies are charging 300, 400, 500, 600 pounds a day, and the plumbers 400 or 500 pounds a day. And in London, this is it is not a cheap industry, and it is very difficult to keep within budget, especially when you've got this massive inflation that you're battling.
It's a bit of a tangent, but it's sort of aligned to that. When you're looking at a project, and we'll maybe talk about the process of how you apply for finance shortly, but if a scheme comes across my desk for me to have a look at and say, look, would you consider lending to this scenario? It is quite glaring, I think, sometimes when you do get a first-time participant or someone who's maybe lacking in a bit of experience, and you look at the build costs, and it's just obvious that they're out. And I'm by no means an expert, but the more and more deals you look at, you do get a feel for where costs are going to roughly be on a pound per square foot basis. And I think sometimes a first-time participant might actually end up getting declined for finance because they just haven't been realistic in terms of actually how they've presented it. And it may well be that in due course they're going to bring on board people who are going to give them advice, etc. But the earlier you bring them on and present yourself to the finance market, you can present yourself a lot more professionally. And are you actually going to get better access to finance if you've actually really put a considered plan together?
It's because they watch Homes Under the Hammer, you see. And then Homes Under the Hammer, everyone's refurbishing houses up north for like $4,000 each. And they're like, oh, we're going to do all this work for $4,000. I'm like, Christ.
And in those scenarios, quite often
tiles for the bathroom.
I know, and invariably they're unrealistic, and people
exactly.
spend way more than that for sure.
Exactly.
Yeah.
So in terms of how with bridging and development finance, how does a lender like yourself price their loans? Is it based on the base rate, or what do you base it on?
So I'm sure every lender will have their own very specific source of funding of how they how a lender gets its money, which it's going to lend to you, is going to really drive how they look to price a loan. But I suppose the biggest driver of actually what you can charge on a loan is the market itself. So, for example, it may well be that you, as a lender, you want to charge X, but actually the market just won't facilitate you doing that because it's just so competitive. So, competition is the biggest driver of price, setting everything else aside. But really, how we look at lending, like we get our money from an institutional source, which will be charged to us at a rate over the prevailing SONIA rate, which is the replacement effectively for LIBOR. Yeah. And so our lending is really intrinsically linked fundamentally to the prevailing base rate at any point in time. And so really
just in a more complicated way.
Exactly that. So how do we price? Obviously, if we are then going to pay a margin over that, we then obviously need to make a margin ourselves for you to be able to, for us to be able to make money. And so, and really that's the very basic principles of that. But then how the minutiae of how we price something will be all about risk. So if you want to push yourself up the leverage curve and go up towards our maximums, we're going to charge you more money. And then also we would add what we would call risk factors on.
Max would be 70% loan to value at the moment.
It is for
a bit more, but you pull back slightly, haven't you?
Yeah, we have at the moment.
Most lenders have, I think.
I would probably concur with that. I think there is still quite decent access to 75% finance in the market, but you will pay a premium.
Quite highly geared, I think, for development. I mean, we normally put down about 40%. I think.
Yeah.
We feel is if we're putting down 40% in cash plus we're buying under market value. In reality, you're more like 50-50 in terms of your leverage. So I think is a good place to be.
Yeah, I mean, but for sure, if you want to push up to 75% and really squeeze that extra 5% out of the market, you will pay for that. You will pay more money for
the risk.
Yeah,
and
exactly.
I guess the risk kind of goes up exponentially as well, right? I mean, if you're gonna,
exponentially is maybe a bit strong, but I take the point.
But it's more risky. The 5% between going from 30 to 25 is I would think would be less of a worry for a lender than going from 20 to 25 or 20 to 15.
Yeah, completely.
Because you're getting closer and closer to really where things can go wrong.
Yeah, where the pinch points are.
Exactly. Yeah. Exponentially is probably an exaggeration.
But So yeah, and then the other factor, other than leverage, for example, if someone's got maybe bad personal credit, or maybe even their business has got poor credit with CCJs or similar, we might want to put a pricing premium on for that. If we would still lend, CCJ personally, and it depends what that is. It's all contextual. All of the lending we do is judgmental. So if there's something else great about the project, the leverage is maybe attractive, it's a really good property, it's simple, then we might live with a bit of hair on the borrower, for example. The other scenarios, if you're doing particularly heavy works on refurbishments, we might want to charge a premium for that.
If you've used that one on me before.
Quite possibly. Commercial property, we would probably perceive there's more risk to than residential property, so we might charge a premium for that. So I think, we're just looking at where we think the risk is. That's the key drivers would be what the market is, what our own funding is, and then the specifics of the deal, and we would tweak around that.
And what are your range? I know you can't give a specific rate because if someone's putting down 60% deposit, then you're going to offer them great terms over someone who's putting down 25, 30 even. What's your sort of range of rates?
So it is very, very difficult, as you say, because it is a very, very big range. But we're certainly sort of seeing rates probably from, I don't know, more typically about 0.8 a month, I guess. We can do a bit lower than that, I guess, but that would be a fairly good start point. But
that's not above the base rate. That's working out overall.
In total, including our margin and the base rate.
So that'd be 9.6%, roughly, give or take. I mean, I remember when I first started taking bridging loans and stuff. I mean, it was like 0.54, 0.57,
Yeah, or
0.62, 0.64.
so 0.6s might have been quite attractive. Yeah,
Days have gone.
they have, because the base rate has gone up, and fundamentally the cost of money has gone up.
But when I first went into development, and at the time when I was sort of becoming a professional developer and actually using bridging finance, development finance, a very well-known developer said to me, Ben, if the deal is a good deal, it will work with the finance costs that you've got to put into it. He said, if it doesn't work with the bridging finance costs, it's not a good deal. And I thought, oh yeah, that's easy to say for you. But I guess looking back, I kind of get it. Like, you know, the deals that you're doing, especially if they're larger deals and you're in London or in a city where values are quite high, you know, there is risk involved. And I think the reason why most developers look to make at least 20% return on cost. So if they spent $1 million all in, they want to make 1.2 back, they make 200 grand.
Yeah.
And the reason for that is not just because they want to make lots of money, it's because they also need to cover the downside of if the market falls 15, 20%, they can get out in theory without losing the shirt off their back.
No, completely.
Whereas some developers will buy things to make 7, 8, 10%. You know, like
which is mad.
Of course it is.
Yeah.
And then, you know, like in 2008, let's say, I mean, London, the market didn't drop more than about 15%, maybe 20% in places. But some places like Northern Ireland dropped like 50, 60, 70% in places. I mean, the market was decimated. And, you know, that it's important that you always factor in the downside.
For sure.
Things can change quickly.
I mean, in the context of your traditional capital stack, you know, it is your senior debt wants, you know, they're taking the least risk, so they will take the less rate. Then maybe mezzanine finance, you know, they're a little bit up that risk curve, so they will charge a bit more. And then you're into equity. And why wouldn't equity want a better return than both the senior lender and the mezzanine finance? And if you're not getting it, you do sort of question the deal to a certain extent.
Well, it doesn't make sense, does it? I mean, I think, you know, most of the if we're doing a joint venture and I'm not funding it myself, then I will. Most of my investors will want to be making between 25% and 40% per year on their money invested.
I mean, I was with a fairly big regional house builder at the beginning of last week, and you know, he was looking for 20% on his GDV on every scheme that he was looking at. And I think that's.
You mean return on cost, 20%?
No, so that was actually on his return on GDV, which I think. I forget which way around it always works. So I think
there's so many metrics to work. It does get confusing.
Exactly, and you know, I think valuers tend to adopt about 15% profit on cost generally. When they do a residual valuation, so it's in those sorts of ballpark. I think where the market expects people to be targeting returns. And I don't think that's uncommon. And actually, it might even be a parameter which we look at as a lender to make sure you are making money on a project. Because if you're not making any money, the chances of you, when things start to go wrong, actually being further committing and wanting to put more money into that project is slim to none, right? So we even want to see that you're making money, because you question why you're actually going to do the deal, and are you going to be motivated to stick the course, really? Yeah,
I mean, just to give an actually real world example. I won't say the property address just because I don't want the investor to people to know who the investor was or whatever. But we recently did a deal in London, and you know, it took us 13 months end to end. Percentage-wise, I think the deal made about 78% in terms of return on equity invested, and the investor had, you know, roughly half of that. So that would have been 39% on his money in 13 months. So if you annualize that, which everyone does, then you know it's probably like 36%, something like that. Now, if for every 100 grand you're giving me, you're getting back 136 at the end of it, or you're making 36. That's, I mean, you're not going to get that in almost any other investment.
No, I agree.
I mean, you might get it if you get very lucky at the beginning of Bitcoin, but you've probably lost it all since then. But you know, that's an example of it going really, really well. Obviously, JVs can also not go as well as that, and
sure.
You know, we've had deals that have made a lot better returns than that, and we've had deals that haven't made as much money as that. So I think the key with this is it's an average. It's a batting average. You know, it's like if you do 5 deals, 3 or 4 of them are great, or 3 are great, one's average and one isn't great, then that's a pretty good batting average. You're going to be making quite a lot of money in this business. Whereas if you're doing 5 and you've got 2 great ones and 3 poor ones, you know, you're probably going to be lucky to be making any money.
Agreed. Yeah, but you like you say, you need to factor in that profit margin so that you've got the opportunity that if things don't go quite well, you're not, you know, wearing the hair shirt at the end of it, essentially.
Exactly. Yeah. And I think one thing probably people that are new to property development don't realise is that generally with bridging and development finance, it's not like with a mortgage where you take a mortgage and you have to pay your mortgage payment on the 28th of each month, otherwise they'll try and repossess you. Generally, you guys will roll up the interest payments and it'll be paid out of whatever the exit may be, whether that be a refinance or a sale.
For sure. So if you're doing a more traditional bridging loan, when we say that you're going to borrow at 70%, that's your total gross loan, and bear with me, it's a probably difficult thing to explain rather than write out as numbers. But and then what you might actually deduct is what we would assume would be your 12-month interest cost. Yeah. So we actually deduct that from the loan so that you don't have a service burden on that loan.
So what you're saying is, just to make it easier for people to understand, so say someone wants to borrow $1 million from you. You will, within that $1 million, say the interest for say it's a 12-month term.
Say it was 10%.
Say it's $100,000.
Yeah.
The net loan will be $900,000,
exactly,
and the $100,000 will be kept back to make sure you get paid
our interest cost during that.
It's a clever way for you guys to finance it, but it makes total sense. So the positive of that for the lender, for the borrower, is that you obviously your cash flow is massively improved. You haven't got to pay
that
$5,000 a month,
yeah.
6, 7 grand a month.
And invariably on a bridging loan scenario, and certainly on a refurbishment scenario, which we'll come to on how interest is treated there next. The assets aren't income generating, so it might be that the property is dilapidated. It might be that you've bought a property and you actually want to get a tenant in there. So you haven't the asset itself isn't generating cash flow for you to be able to service interest.
And that basically forces or makes it much more likely that the borrower will actually use the money to get the building done.
Yeah, exactly.
Because for you, the biggest risk, and the biggest risk for anyone owning property, is the time frame between breaking ground on a project and finishing it.
Yeah.
Because if you have to repossess an asset when it's got no floors, no ceilings, hasn't been first fixed wiring, whatever, for you don't want to go in there and find someone.
Complete disaster for us.
Me up and ask me to do it.
I mean, it's probably our worst nightmare to come into a project halfway through. We are not property developers. We have no desire to be in possession of a property.
If you get anything like that, though, let me know.
For sure. We've no desire to be in a possession of property at any point, really, but particularly if it's part complete. There's no win there for anyone, to come into a part complete scheme. But just in terms of how we treat interest on what I would describe as a refurbishment loan, I think earlier we were touching on the fact that you would have a day one value and then you'd have a future value once a set of works are complete.
Yes.
If we are funding those refurbishment works and we are going to monitor you doing them, we can actually allow, not only will we lend that 70% day one, we can actually allow interest to roll up on top of that account rather than being deducted, because we know we're travelling towards that future value.
Fine.
Now, in those scenarios, we're obviously going to be monitoring you to make sure you've started work, like you say, breaking ground, and we're going to be monitoring you throughout to make sure you're making progress so that we do actually get to that end value, because we're going up that leverage curve by allowing that interest to roll up every day. But if we know that's happening, and we'll get a professional valuer to say, what's it worth today? What would it be worth in the future based on this schedule of works and based on this budget? And we can travel towards that future value. And so not only are we actually essentially providing you with the facility to service the interest, it's not being deducted from your day one. So
in a nutshell, what you're saying is if you're able to track the increase in value and you're able to evidence that via a professional, then you will also track alongside that with extra borrowing. As needed. And
we can only do that where we're funding the refurbishment costs. So
you wouldn't do that with the bridge.
No, we wouldn't do that with the bridge. No.
Yeah. Makes sense.
We have to be in control, essentially. We're not in total control, but we have some control over.
I have to say, out of all the lenders I deal with, you guys are the most reasonable when it comes to the control. Some of the lenders I deal with are very, very tricky, and they really want me to be absolutely screwed down on everything as to what we can and can't do, which is quite frustrating sometimes. Because
I suppose when you become a repeat borrower of a lender and you're repeatedly successful with a lender, the degree of the comfort that they're going to take, and the degree to which they're going to monitor and trust you is obviously going to increase. So you probably benefit from that.
Absolutely.
And so it's not the same in all scenarios, and it really does depend. Like if something's very, very structural that someone's going to do to a property, there is the potential that if that goes wrong, that actually you might be hoping that you're going to travel towards an increased future value. But in the very short term, you could actually be devaluing the property. So in those types of scenarios, you might expect a lender to be a lot more buttoned down on their controls. Yeah.
And just in terms of fees, when someone does a normal mortgage, they might pay £1,000, £2,000 arrangement fee plus a valuation fee of 500 quid or whatever, and then they can be added to the loan as well.
Yep.
With unregulated finance, the fees are much higher.
So I would describe Octane as a broker-led business. So I would say more than 9 out of 10 borrowers that come to us are introduced to us by a finance broker. And
9 out of 10?
Oh, probably, yeah. I mean, I don't actually know the number, but we are very much a broker-led business. And I think a lot of borrowers do like brokers because they actually have a full sight of the whole of the finance market. And they will also know if there's a few bad eggs in the basket in terms of some lenders. And particularly when you're first starting out in finance, you won't probably have contacts. Some people might not have, well, I'm sure there's a good deal of people who hadn't heard of Octane, and they're only really introduced to us by brokers.
Yeah.
So they are a very valid part of the unregulated sector, and almost needed really to help people navigate it. But so I would say that typically the unregulated finance market probably at the top end is probably 2.5% arrangement fees.
Yeah.
You can go down to probably 1%. But it's very rare that you see less than that, I would say.
Yeah.
That I would say that's probably a fair guide. Yeah.
Yeah, no, that makes sense. I mean, I think in terms of what I was mentioning also about other fees is legal fees generally are going to be for like a single unit deal that we do anywhere between sort of £3,000 and £5,000 plus VAT on the lender's side. So then I would have my conveyancers fees, I would have my commercial lawyers fees. I may even have a leasehold specialist lawyer's fees as well.
And that's just on your side?
That's just on my side. Then I've got the lender's fees.
Most lenders will operate what we would call like a zero cost business. So if we incur a cost for lawyers,
we pay it.
Essentially, the borrower pays it. And look, I'll be brutally honest, that is a feature of the finance market.
No. Listen, I'm used to it now. I mean, I don't even bother to ask anymore who's paying for it.
It's more for setting context, I guess, for anyone that's listening.
Of course.
Like, I think if you're expecting to see someone who's going to wear that as a lender, you're going to be very lucky.
And if they did, they just be reflected in the rates anyway.
Of course, yeah.
Because really all you're looking at is how much money you make overall in the scheme, right?
I mean, look, at the very low end, you're probably expecting on a very simple low value property purchase maybe £2,000 for lenders' legal fees. But I
normally pay £3,000 or £4,000 per flat, I reckon.
Yeah, I would say that's fairly typical
plus
for
VAT.
you.
Always plus VAT. And then in terms of other fees, you've also got, so there's two different ways. I know you do use quantity surveyors sometimes, but for the most of the stuff I've done with you, you've had an asset manager, which is a much more economical way of doing it, and it's much quicker. And I've worked with your asset managers now for years. I know them all by name. They're great guys. They're very fast. They'll come in. They'll do a report like next day.
Yep.
One of the things I love about dealing with Octane Capital is they are very fast with drawdowns. So when we're in the middle of a deal, we've front loaded it, so we might have, I don't know, 50 grand that we've set aside to buy materials.
Yep.
That can go very quickly. A kitchen could be 20 grand gone like that.
Sure.
So we'll do that. I'll then email Rick and say, Rick, right, I want to do a drawdown. Here's all my receipts. This is what I would like to draw down, 43,000, whatever. You'll send in the asset manager, who will walk around, take a load of photos, go, we're happy that, can you send us the receipt to prove that you have actually bought this kitchen and not just spent it on holiday? And then the money will be drawn down. And generally within sort of 48 hours, maybe 72 hours, you'll give me a drawdown. Most other lenders I deal with, it takes about a week.
Right, okay.
They're pretty good. I won't mention names, but they're pretty good. We've had a couple of howlers where it's taken like 10 days, 2 weeks, and that doesn't sound like a long time, but when you're churning through cash at a rate of 10, 15 grand a week on a small development, on a big development, you might be going through 30, 40, 50 grand a week when things are really in the second fix phase of buying all marble tiles and all expensive items. It's really critical that stuff's done quickly. So I much prefer that approach to the quantity surveyor approach.
So I think it really depends on the lender as to what approach they take as to how they want to monitor a refurbishment.
Yeah.
I think for us at Octane, the difference would be if something's getting to be towards north of £500,000 as it is in the total works package, and it's going to be structural in nature, we would start to think about getting a professional project monitor involved in terms of monitoring our risk on the build. And they can probably cost for an initial inspection maybe £3,000.
Yeah, and then about £1,000 plus VAT per thereafter.
Yeah, and then about £1,000 per drawdown,
which adds up, especially if you're doing on another project. I did a very small drawdown last month, and I think I drew down £8,000 plus VAT maybe.
Right,
and because they were every month. And I was paying the US £1,000 plus VAT, and I was just like, disappointed. I should have cancelled it, to be honest.
Well, I think that's one of the other things about a lot of quantity surveyors and project monitors is they actually want to inspect monthly.
Yeah,
and it's almost like that is how they operate. So it may well be that you're not ready for a drawdown, but they're still coming out on that month. Whereas with an asset manager,
12% of that drawdown, I'm paying in fees.
Yeah, which is crazy.
Yeah, it is crazy.
Yeah, I mean, you'd like to think that the lender can be a little bit more flexible.
To be fair, I didn't ask them. I think they probably, if I'd said, "Can we delay it by a month?" they may have done.
And then in terms of our asset managers, look, they are not project monitoring specialists. They're sort of property generalists, really, and they are really doing a make sense test. So like you've said that you spent 50,000. We've evidenced it via invoices, and then they're really just kicking the tires around the property to be like, well, actually, does it actually look like they've spent 50,000? And they're really there to stop own goals.
Yeah, no, absolutely. Yeah. So we've talked about various ways of buying property. We've talked about buying it 100% cash. We've talked about buying it with the bridge and development finance. I think there's also the way that we as a business tend to buy properties. We do a hybrid version of the two. So we will generally exchange as cash buyers.
Yep.
So we will be cash buyers. If we need to buy something as a cash buyer, we can.
Yep.
Which obviously it's taken time to get into a position where that is the case. But we will generally want to refinance before we complete, if possible. So we don't. So you've only got to put down 10% on exchange generally, unless you get a tricky seller who wants 15 or 20% for whatever reason. So we will generally put down the 10%. And then hopefully have a delayed completion. Say normally I get at least 4 weeks for an exchange completion. Sometimes sellers don't want it, and they're tricky about it. But we will generally exchange as a cash buyer, and then look to refinance onto a bridge or a development loan. And for me, this is the smartest way of doing it, because you're at the top of the pile in terms of the buyers, because you're a cash buyer.
Yep.
But you are then straight away maximising your return on equity invested by leveraging and taking advantage of leverage. But you can still exchange incredibly quickly. So, but obviously the caveat of this is you have to have the cash there to back it up. I would not advise people to if you don't have the cash behind you, not to do it. A little confession here. When I bought Leamington Road Villas, which is still to this day the biggest development deal I've ever done in terms of profit. I won't say how much, but it was a fantastic deal. And when I purchased that, I had 3 or 4 hours to do the deal. I've been told by the agent I had 1 day to exchange, but I knew that there was about 6 or 7 other developers that wanted it. I had agreed on a handshake, basically, that I had about 300 grand in cash at the time because I had money invested in other deals, and I had an investor putting in about 500 grand. And we never even had a written agreement. I rang him and I said, listen, if you don't come through with this and I'm going to exchange today, I'm fucked. So we can swear on the podcast.
Yeah, okay.
And and I just said, look, please promise me that you won't not come through. And he was like, look, I promise you. If I say I will. And I trusted him. And I did the deal. I wouldn't advise people to do that, but it did end up meaning that I did the biggest deal in my career by some large margin. So sometimes you take risk and it comes off. It could have equally gone badly, and I could have lost £80,000 deposit funds plus costs and been sued by the seller. So I
mean, thankfully it doesn't happen too often, but we do sometimes see scenarios where people have exchanged on properties and then they find that they're essentially unfundable properties, and you see them do the rounds in the finance marketplace, and it's sad really when it happens, because someone's going to lose out.
It's very rare for people to fail completion. I think when I was an agent for 10 years on and off, and I had one buyer fail completion.
Right.
And eventually I think they completed. Eventually.
Right, okay.
But it's quite rare. It is quite rare. I mean, you might see it happen occasionally. But anyway, so going back to what we were talking about, so the hybrid model, I think, for me, is the best model, assuming that you've either got the cash behind you to do it. So you can't really do this from day one.
No.
Once you're a bit more experienced as a developer, you can do this, or that you've got an investor in your corner that has plenty of cash and can back you up.
Yeah.
Then I would That would be my advice. But obviously, you've got to start off somewhere. We should also briefly touch on mortgaging to develop. Using mortgages to develop is mortgage fraud. It's actually illegal. Most people don't realise that. You can't go around saying that you're buying something to live in and then knock it all down and then flip it on. Lots of people do it. I wouldn't condone doing it, and I think lenders are a lot more switched on now than they were 10 years ago about this.
For sure, yeah, and I think for a lot of people when they first start out, I think that headline rate that you get with a mortgage is just so attractive. And I think the difference between, I guess, the commercial, or I'm going to call it
about a third, probably, or 40% between Pen and Bridge.
I guess a commercial lending operation like Octane and a traditional house mortgage. But there's a reason why those house mortgages are so cheap, because they are geared for people who are buying a primary residence, who are going to reside in the property and are going to pay it from their personal income.
That's the key, isn't it?
And as soon as you vary outside of that, you are absolutely right. You would be committing mortgage fraud, and you will exclude yourself from the financial system if you get caught out for something like that.
And there are limited refurbishment mortgages out there, but they are products they're more expensive than conventional. So instead of being, say 4% mortgage, they might be 6.5%, 7%, but they're also for people to live in them afterwards.
Yeah, exactly that.
It's
for a primary residence.
Yeah.
I know you wanted to briefly touch on what's regulated and unregulated.
Yeah.
And where a product is for a primary residence, that's a scenario where it would be a regulated product.
Yeah.
Now, we at Octane don't do any regulated loans, so I can't really talk.
I asked you about regulated loan, didn't I, the other day? And you said you couldn't do it. You said, because it was, I won't go into it.
But I mean, I guess where you might see a regulated product become something that's attractive to a developer is if you own your primary residence and it's got a substantial amount of equity in it. There are participants in the marketplace who will provide regulated second mortgages quite often so that you can extract some of that equity, which you can then use to invest.
Would your first charge lender allow you to do that?
Some will, some won't.
With the deal
I think
maybe they would?
As with anything in life, it depends on the circumstances. But usually if you're at a suitably low loan to value, then most high street lenders will consider having a second mortgage on the property. But obviously if you're up that loan to value curve, then the chance of them accepting that is probably pretty slim.
Yeah. Makes sense. And just something that's I've touched on this before on this podcast about personal guarantees and charges that are put on your personal assets or perhaps your company assets. I think there was this old rule that never have a personal guarantee, but in reality, in the world of commercial finance, property finance, it's very. I mean, I think we have done deals in the past where there hasn't been a PGR that's been very low, but I think it's been on the premise of having a very large deposit. And lenders generally, if you're putting down under 50%, they're not interested. They want some. So what do you want to explain the difference between?
Just, I guess, talking more generally about security for a loan. Most lenders, well, virtually all property lenders, their main security is a first legal charge over the property itself, the asset against which they're lending. That is the primary piece of security. Then you really get into secondary security, which is outside of that, and lenders will always want to take as much security generally as they possibly can. Most people most people will borrow in a limited company. If you're borrowing in your personal name, it almost starts and finishes with that fixed charge over the asset, because if you borrow in your personal name, that lender has direct recourse to you personally, and there are no other. And the concept of a debenture, or which we'll come on to in a second, doesn't exist in a personal capacity. But most people probably do incorporate a limited company enterprise to buy properties. And so you can take your fixed charge over the property, and the lender's likely to want a debenture, or in other language, a fixed and floating charge. Now,
they're the same thing, right?
Yeah, they are the same thing.
Got you.
Now, what is a debenture for a property company that's just been set up to buy a property?
No assets in it.
There's probably no other assets. So you might question why a lender wants that. But for a refurbishment scheme, what a debenture does give you, if you hold a first-ranking debenture, is an out-of-court power to appoint an administrator or receiver.
Interesting.
So that's why it's often quite important for a lender to have a debenture.
And I guess you also never know what could come into that property.
Exactly.
Into that company.
Yeah.
So you never know what. Sometimes people might be silly. They may add something into it, not realise it, and then they forget that they're.
There might be some other
asset. They buy a van or whatever, and then something silly. I don't know, whatever. So that's interesting.
But that's sometimes why that's important. But in putting the property into a limited company, you are limiting your own personal recourse that the lender will have, because it's lending to the limited company, which is a separate legal entity.
So it's a safer way of doing it.
So really what we're saying when we ask for a personal guarantee is to say, well, look, you want us to lend you this money, but you're essentially giving us no recourse to you as a person. So how do we know you're just not going to walk away from this project? So now the obvious answer is, if you've got a lot of cash in the scheme, the chances of you wanting to walk away are considerably lower, because you want to get that cash back out.
Of course.
Now, so as we go down towards 50% leverage, generally speaking, a lot of lenders will say, well, actually, you've got so much cash in this deal, the personal guarantee is okay. We can live without it.
Yeah.
But once you start to push over that 55, 60%, you are going to see lenders wanting a personal guarantee. And sometimes we can limit those if it's a good borrower. Maybe it's the second deal for them, and you might see them limited towards 15 to 20% of the end values of properties. Yeah,
makes sense. So you're based on the GDV basically.
Yeah.
And okay, so I think you've explained most of that. I mean, one thing that I always find interesting, so first, second, third charge, we don't normally have too many third charges, but first and second charge, I mean, so you would always take first charge as if you like the primary lender. And then one thing I've learned about doing this is that you have there's two words for it. There's either two phrases, deed of subordination, or there's another term for it as well, which my solicitor uses instead. I can't
like
remember.
An intercredited deed.
I don't know. Anyway, it's basically a deed of subordination whereby lender B. So let's say that would be, say I did a joint venture and my investor puts in some equity.
Yeah.
His solicitor may want a second charge on that money. Octane have first charge. He has second charge. And then you have a deed of subordination between the two of you, whereby it basically states, we're the big guys, we get paid up first, you get the scraps.
Yeah, so
in a more sophisticated way.
Yeah, so I think that, just to be clear, I guess there's two scenarios in which a second or even third, fourth, or whatever charge, but let's talk about second charges, might arise. One, you might have an investor who is really behaving like equity. So they're really your JV partner.
That's what we would have with our JV partners.
But that JV partner wants to protect their interests to some extent by having a second charge over the property. Now, to us at Octane, that's an acceptable scenario to have a second charge, because really that is someone behaving like equity. And what we would have is a deed of subordination or an intercredited deed with that second charge holder, which basically says, look, we hold all rights, we're the first legal charge. Once we're repaid, you can do what you like, but we have to be repaid first. What you also get is a second scenario, which actually, generally speaking, isn't acceptable to Octane, but there are lenders who will accept it.
Which is what?
Which would be mezzanine finance.
Right.
And they would be a second charge holder
so you don't like that?
We don't. And there's
Why is that?
There are a plethora of reasons, and we'll come on to that just in a second. But just explaining why, just explain that scenario. That mezzanine lender is commercially motivated. They haven't got any of that equity upside that other investor has.
Makes
so
sense.
Them signing an intercredited deed, which is you, Octane, like you do what you like and I have to accept it, probably isn't acceptable to that mezzanine lender. So they may well want to have other more nuanced clauses in that intercredited deed that gives them some control. They may want the option to buy our debt, for example, so they can step into the senior lender's shoes.
They might allow that?
We might allow it.
Yeah.
We might allow it. They may well want some of the default clauses in the facility letter to be harsher, or to enable them to cure potentially defaults in our facility.
Interesting.
So if you're, because they're higher up that stack, if the property has devalued, for example, 20%, and we're lending at 70%. We're not okay with that, but we're still looking at our loan thinking we might not lose money. But they're potentially losing money. Yeah. So they might not actually want us to repossess a property at that point in time or have to put it on the market. And we're talking about adverse scenarios here, right?
It's interesting.
The way in which they're going to look at the world is very, very different. And that can become quite a complex negotiation between a senior lender and a mezzanine lender, which is one of the reasons. There are other reasons why we don't like it, because it can become extremely messy. But perhaps the biggest reason
and litigious, I would say.
Perhaps the biggest reason we don't really like it, to be honest with you, is it usually just speaks to an undercapitalised deal from our perspective.
Yeah, it's too highly leveraged, too
exactly.
highly geared.
Yeah,
fine. So that's interesting. So I think that's probably all we need to talk about on PGs and charges, and we don't want to drive everyone mad with boredom.
Oh, like, you could talk about it for ages, but it would be very, very dry.
No, well, but this is such an important part of developing, and in reality, you can buy things as cash buyers forever and a day, but if you really want to expand your business and grow, you really need to do.
I suppose it would be slightly remiss of me to say when you start talking about security and what it means, getting a good lawyer on your side and getting them to run through and just getting them to explain exactly what it is you're signing up to is paramount importance, just so that you fully understand it. There is no substitute for that.
Rick there. Yeah, I mean, great. I mean, I often whinge about the tens and tens and tens of thousands a year we shell out in legal fees, but I have to say the legal team I've got, if they're listening, they are bloody brilliant, and they, as much as I might whinge and push them sometimes to hurry up and do things, they are. I'm
sure, like you're probably getting blasé because you've done so many, right? And you see that personal guarantee, you kind of know what it means. But certainly when you're starting out, you really do need to just make sure you fully understand what you're signing.
Thick. I mean, like whenever I go in to sign up, whenever I go into the lawyers to sign a deal, because it's normally me that does it. If it's a JV, it's normally me that does it. It's probably like 100 pages of stuff. There's like 5, 6, 7, 8 documents. They're all, some of them are like 20, 30 pages long. It's all blurb, it's all legal speak. Yeah. It is really important, like you say, that you get someone who's really good at acting for you. So just in terms of the process, so we've talked about all the different types of finance. I think just in terms of the process, and we don't need to go too much in the detail. We've been talking for a while now, but I think bridging finance development loans, they generally take, I mean, you guys are about the quickest I've dealt with. I think we've done deals in like 3.5 weeks, maybe.
It's certainly possible. I mean,
it comes down to the value really as well, how quickly the value.
I think there's a range of things that are pinch points. So just talking through the process, I guess we'd get a loan application. We'd hope that within sort of 24 hours, we review that application, set out a range of underwriting questions. We'll run some basic background credit searches, etc. And then we'll come to you with some underwriting questions like, can we have a copy of your build budget, or what's your source of deposit? So that process is fairly quick. If you are quick at responding to us, we can usually respond to any response we get within 24 hours.
Makes sense.
So you're really the master of your own destiny in that respect. The other, if we have to get an independent valuer to value a property, you are to a certain extent at the mercy of how quickly that valuer can get out and get access to a property and then turn around a report. The more complex the property, the more the time frame is coming back on those time frames. So that's a pinch point. And the second pinch point is legal property due diligence. So if you are buying a property where you've got existing searches, you know the full planning history, etc., and your solicitor is very, very quick at responding, that also compresses the timeframes. But usually it's in the professionals where the pinch points can become.
Definitely. I mean, we on Hamilton Terrace, one of our developments we're doing at the moment, it took us 6 months to get a bridge sorted, which is just ridiculous. I won't say which.
I mean, that sounds like an outlier.
I hope so. I mean, I have heard they are quite slow, this particular lender, but I mean, it was maddening, really.
I mean, we generally sort of say to people that it's 4 to 6 weeks. You can definitely compress that if you've got everyone on board and everyone's responding and working quickly. I mean, you see these deals that are sort of occasionally publicised out in the market saying it was done in 3 days or in a week. They're very, very few and far between.
It's very difficult.
Very, very few and far between.
I think the quickest we've done, as I say, is 3.5. I would say our average is probably 8 to 10 weeks. Yeah. I would think. I mean, generally, if I know something has to be fast, I did a 4-week deal actually on the purchase something in Muswell Hill. Two. Right. I bought 2 flats, turned it into 1 house, which is unusual. Extended it up and back, and that was 4 weeks with one of your competitors, which was quick.
Yeah, that's very quick.
And then they were terrible thereafter. So it took them 2.5 months to go from a bridge to a development loan.
Right.
So they did so well, and then it all just fell apart.
No, 4 weeks is good, I would say. Like if you're doing 4 to 6 weeks, it's pretty good, I'd say.
Yeah,
but it is possible to do it quicker.
I shouldn't have cheated on you, Rick, should I?
No, definitely not. But you have to have your ducks in a row if you want to transact quickly, for sure. Yeah,
and just in terms of let's say hypothetically, and this actually happened on Leamington Road Villas, the deal I spoke about earlier. That was a great deal for us. We overspent on that deal. Mm-hmm. I think we overspent by about 70 or 80 grand probably, and I ended up putting that all in cash out of my own pocket. And it wasn't ideal. I had loads going on at the time. And so I then came to you and said, oh, can I do a further advance? And you can sometimes do further advances if there's a headroom in the facility.
Yeah.
Is that right?
Yeah, so if you've already pushed up to the maximum leverage on when you're doing your first loan,
Yeah.
then the capacity to do that is going to be far more limited. But if you haven't, then usually, as long as the project's going okay and everything else is
Especially
fine
if
about
it's
the
complete,
project.
I guess.
Yeah, particularly if it's complete, or it might even be in the lender's interest if you have just run out of money on a scheme and you are, say, £30,000-40,000 short. Like, who's winning, right? If the lender's not going to be able to say, well, okay, well, I'm going to have to just get you there. There are scenarios in which you can do it. But it is all going to be leverage dependent.
Yeah, the fees are expensive doing it relatively, because if you I think when I borrowed 70 grand, the fees would have been probably £7,000.
Everything's a little bit out of
10%.
Everything's a little bit out of kilter because you have to instruct a lawyer to prepare all the legal documents, etc., and it can look disproportionately expensive compared to what they did. But it's still the same work that they're putting in, whether or not it's a small amount. It looks disproportionately more expensive from a fee perspective.
I think, look, to sleep easily at night, other than health stress, I think financial stress is the worst possible stress other than being ill. And I think for the sake of paying a few £1,000s in lawyers' fees to sleep and not have to worry about, oh God, am I going to be able to pay the mortgage next month?
But sometimes as well, people up spec developments and they then think that there's a higher...
guilty of that.
Yeah, there's a higher gross development value at the end, and sometimes you might actually say, well, actually we've changed it, or we've achieved an enhanced planning consent, can we do this, but we're going to need more money to do it. Those are all scenarios you can look at.
Our GDV went up 200 grand, which was, we spent 70 more, we got 200 grand more, so we were 130 net up, which was great. Doesn't always happen though, so you can't rely on it.
Quite.
But so that's interesting. And I think really,
I should say they're pretty straightforward as well. Like, as long as it makes sense,
they're not. Weeks, I think.
They're not particularly complicated things to do.
Yeah, no, absolutely. I think really the key in developing is everyone looks at just the P&L, how much money, the profit and loss, how much do you make, but actually the time frame that things take to do. I was looking, plucked out some numbers, and we're about to do a deal together in Knightsbridge, and I've worked out that the interest per day is £590 a day, and that's one deal of maybe 6, 7, 8 deals I'm running. That's a bigger deal, to be fair. But I mean, that is quite a scary number when you think of it like that.
It is, and I suppose when you just talk back about how long it takes to do drawdowns, etc., when you're spending £500 a day in interest, get someone getting you the cash flow so that you can move on and keep that project moving. It's all about speed and cash flow, right? So that you can not be paying that £500.
It does focus the mind.
For sure.
I was actually last week I was seriously considering buying some timers for each of our deals and sticking them in the office, and I didn't do it because I thought to myself, I'm just going to have mental health breakdown. So I was like, I was going to buy these little timers, you set them, and I was thinking it will motivate me and the team to get things moving, and I was like, do you know what, Ben, you're already under huge pressure. Just leave it, make your life easier. So I didn't buy any timers, but
no, I can understand why, but time is the biggest thing.
Red ones.
Yeah.
Good. Well, I think, and just to cover all bases, and it doesn't happen very often. I know it's certainly with unregulated finance, it's quite rare for people to get repossessed. I mean, you generally try and work with people to sort the situation out. But in terms of what's the process, if say someone can't sell it, they go past the end of their 12-month development loan period, there's a penalty to pay, presumably. Yeah.
So I guess when loans, when you get into a scenario where your loan is non-performing, it's going to be very, very specific on the circumstances. And I'm going to have to talk in very general terms. Because some lenders will probably act more harshly than what I would hope that we would. I think we would always try and be reasonable with people.
Yeah, fair.
But not everyone in the marketplace behaves like that. And so I can't speak for the whole market here. But the way in which I look at a loan which has not gone to plan is really, firstly, the communication that you've had with the borrower. If they've been very open and upfront with you about the issues they're having, what they're doing about it, and maybe where they might even need our assistance, be it in just a bit more time, or maybe they need that further advance. If there's been open and forward communication, that's very, very likely to be an open conversation on our side, telling you what our issues are, and then hopefully you can come to a mutual position where you've got a path forward.
So like all things in life, if it's an awkward situation, just communicate.
Yeah, early.
A lot of people don't.
Early
They
and
don't
open
understand
disclosure and discussion.
Yeah.
Because things don't go to plan. More often than probably what some people would admit, and we can we're not stupid, right? We know what's going on in the world, and so we will try and work with you.
Yeah.
It might mean that might need to pay an extension fee if you've gone beyond your term, and that is going to cost you money. It might well be that we can add that to the loan.
You've got admin hassle by dealing with it. You've got to pay all your staff to deal with it.
And the chances of it then requiring the attention of someone more senior in the business is probably enhanced once a loan starts to struggle as well. So it does cost us a lot more money to run those deals. But at the same time, I think if you haven't disclosed that information, you're not communicating, or you're late in communicating a problem, or actually you've just implemented a completely different business plan than what you originally disclosed to the lender. That's going to be a less comfortable conversation. And are we going to be as amenable to being, kind about it and open about it? Look, the reality is we'll want our money back. Cool. That is the long and the short of it. If you're not communicating with us properly and you're potentially lied about something, we're going to want our money back, and we're probably going to look for the quickest way in which we can do that, either by forcing you down a refinance route, or I say forcing. There's only a limited amount of forcing you can do, but
or repossession.
Yeah, or repossession. But we do always try and work with people so that they solve their own problems first. Because
I can believe that.
The problem with a lender getting involved in sorting out its own problems, we're not property developers. If a property needs finishing off, we're going to have to go and employ a property developer to do it for us, and they're going to want to make money.
Of course.
Right? And that's all getting added onto the loan account. That is all getting added onto the loan account. So the chances of that person getting their own equity back become less and less.
Yeah.
You have to get solicitors involved. You have to get receivers involved. All of these people are professionals. They want to be rewarded for their time. The fees go on and on and on.
Yeah.
And, it's a bad scenario if a lender's having to get involved. Not because there's anything really to be gained from the lender, because all you can really get back ever is the amount of money you've lent plus your interest and your costs. You're not getting any of that upside, So it's a real pain. So we don't want those scenarios, and they take an inordinate amount of time to sort out.
So this podcast is in association with the All About Property Facebook group, which is a group of about 50,000 people on Facebook, and it's like a forum. And one of the guys, I won't say his name, but one of the guys on there, he is a lender, bridging lender. So I don't know how big their business is, but I would imagine they're a small to medium-sized lender. He will often put anonymous posts about dealing from the lender's side and just how silly some borrowers are in terms of, I think a lot of the time as well, especially with developers are not used to being sort of told what to do by people, and they're quite forthright. We know what we want, we know how we're going to do it, and we're used to being in control and being the boss. And I think when a lender comes to someone who's in a position where the shit's hit the fan, I can imagine developers being quite dismissive. And some of the posts that he posts, like some I don't know whether they're developers or whether they're end users that are borrowing on bridges, but they're just so foolish in what the response is, just sort of fuck you basically, and then they realise shit, we're in trouble, and then they're like, oh, please don't charge us that. Well, it's already gone on the account.
You wouldn't believe some of the scenarios you see, but thankfully they're few and far between. And look, most people, like as with every walk of life, it's a very small percentage that that don't behave in the right way. Most people, things don't go wrong for even good developers and things like that, but they're open. They discuss it, they disclose their problems, and you work with them.
Sometimes you've got to swallow your pride. There's many a time in this business where you realise you've cocked up and you go, do you know what? I'm in the wrong here.
I'm going to need it in a couple of months.
10 years ago, I wouldn't have liked to admit it, but in my 30s, I'm a lot better at going, do you know what? Actually, that was not great, Ben.
Yeah.
Well, look, Rick, it's been amazing to chat. I think just to take it away from people being repossessed and losing their developments, a little bit more uplifting at the end. Yeah. In terms of any tips for new developers trying to get into it, any ideas?
Through the lens of finance, I think it would probably
those lenses on.
I mean, because I can't really speak to being a property developer myself.
No, I'm not asking you to.
Because I'm just not. I would say it's probably surround yourself with experience. If you are new to starting out, listen to things, read to things. You don't have to listen. You don't have to take
listen to this podcast.
Yeah, exactly. You don't have to take action on every bit of advice you receive. But I think the more people you surround yourself with who've got experience, you'll see those common trends and traits and the things that you can really pick up on and the things that you can probably dismiss.
Good advice.
take advice from your professionals that you surround yourself with. Get good ones and then listen to them. If they tell you that something's probably high risk, probably is. Now, it may well be that you can see a way of mitigating that risk, and that's a different course of action. But make sure you have put in a mitigant to the risks that they're advising you of.
I think that's good.
Yeah, and just in terms of access to the finance market, I think when you are starting out, you probably are best getting a finance broker involved with you. Just so that they can show you what the whole marketplace looks like. You've got that reassurance that you can compare pricing and you compare different products.
I'm going to give a little shout out on this because he's been my broker for a very long time, and I should say that Kelly Turner at Private Client Finance.
Yep.
Is somebody that I've used and has been very helpful to me, and so I should mention Kelly's name because I'd love him to get some work off the back of it. He's done many mortgages for me and my family.
I do certainly think that when you're starting out that having access to a broker, they will have a lot of relationships with lenders and they'll be able to point you in the right direction. Not all, as with every walk of life, you've got to be careful. Not all brokers are great, but most are. Most are out there to act in your best interest.
Good. And then just final 3 questions. We always ask them to end the podcast on.
I've been dreading this.
Well, the best thing you've learned in this business, maybe you've already answered that, have you?
I think that the thing that I always just sort of say when people are starting out in finance, like if we've got a graduate joining us or something like that, I think really is just you can't actually learn anything without experiencing it, I don't think. And I think I've certainly learned that in my career.
Jumping at the deep end.
Exactly. And, it's probably the same for property development. I don't know, you'd be able to speak to that. But that's probably the best.
Learn it at uni as much as they try and teach.
Yeah, exactly. I think you do need to start something to really, truly learn it. You can't just read things and be taught things. You do actually have to go through it to learn it, for sure.
Great advice, Rick. And 3 people for dinner, 1 famous, 1 business person, and 1 family member.
God, really?
The easiest question in the whole thing.
Probably the famous person. I'm a Liverpool fan, so I grew up in a certain generation.
Growing up in Lincoln, you would be.
Yeah, obviously.
It begins with L, I guess.
Yeah, I mean,
who is it? Ian Rush?
No, probably Stephen Gerrard.
Really?
Yeah.
Well, he'd be really boring, I'm sure.
Maybe.
I don't know. He's not known for his exciting personality, is he?
Share the same birthday, just like a bit of a sporting hero.
Maybe you're long lost twins.
Yeah.
Business?
I don't know. I probably spend so much time in business, I guess, working in finance. I'm not even sure I'd want them to anyone in business to do it. But I don't know, maybe
Philip Green?
No, maybe someone maybe someone in the hospitality industry that I've worked with. So I used to work in a hotels team at HSBC, and they're quite flamboyant characters, and they've usually got some stories. Yeah.
Okay, so someone who works in a cool hotel.
Yeah, and family. Probably one of my late grandparents. I would have thought.
That's amazing to say.
Yeah, just really, if
no one ever says their partner or their wife. By the way, no one has ever. Everyone's always. I always go, "What about your wife?" No.
Yeah, I think that goes without saying.
Stuck there all the time.
Yeah.
And if you weren't working in development finance, what would you be doing?
Oh wow. I think if I always probably would quite like to have worked in healthcare or something like that.
As a doctor?
Yeah, maybe not as a doctor, maybe as a physiotherapist
Dr.
or something like
Hollingsworth.
that. But I'd probably just never had the brains to,
I'm
to
sure
do that.
You do.
Yeah.
So you reckon? Okay, so maybe you'd be a physio.
Yeah, maybe. Yeah, I don't know.
Sorting out people's backaches instead of their defaults.
Yeah. I mean, I'd like to say that I'd have been really successful business person, but I just don't think I've really got that entrepreneurial flair.
Listen, as long as you're happy, that's the main thing, isn't it? And if people want to get hold of you, Rick, what's the best way?
Probably through Octane's website, which is octanecapital.co.uk. Got lots of links to email addresses and contact details on.
Yeah,
for
so
sure.
octanecapital.co.uk.
Yeah,
and I can concur from using Octane for 4 years. They are brilliant and one of the best certainly in the marketplace. So
thank you.
I appreciate your time coming on.
Thank you for having me.
I think that's the first time we've probably ever done a podcast and not had to edit it once. We just flew through that. Wow. So thank you, Rick Hollingsworth.
No, thank you.